All right, it's Thursday. We've got another great episode of Industry Focus Energy planned for you. Jason Hall is with us once again. Jason, how are you doing?
I am doing fantastic. I'm doing quite good. I'm kind of mad that all my favorite yieldcos keep merging and getting bought out and going private. So let's how about we talk about that?
Yeah. So it's been you mentioned that it's been kind of a crazy year. Jason, you've been a big fan of TerraForm Power, which is a yieldco, as well as Pattern Energy, both of which have been acquired or gone private in the case of Pattern Energy. And then in the news we're going to talk about today, this week, TerraForm Power shares are up 11% on the announcement Monday that Brookfield Renewable Partners is going to make a $4 billion all-stock offer to acquire the remaining 38.5% of the business that it doesn't already own. Jason, I kind of mentioned you own both of these stocks, both Brookfield Renewable and TerraForm Power. What was your reaction to that news when you heard about it?
It was a little bit of just like, okay, fine, and not any like major big deal. So you go back a couple of years ago, and we'll talk about it more in the show. But you go back a couple of years ago, and Brookfield Renewable, through its sponsor, Brookfield Asset Management, and some other partners, already had a controlling stake in the business and has for about 3 years now. So I think to a certain extent, a lot of us have just kind of thought it was an inevitability that TerraForm was going to get rolled into Brookfield Renewable. Most of us we were just waiting and hoping that it wouldn't happen for a while, because a lot of us that bought over the past couple of years have done really well capturing the better yield that TerraForm has. So I was just hoping to milk what for me was about a 8.5 or 9% yield on my investment, my actual cost, for a little bit longer. But oh well, great companies get acquired by other great companies all the time.
Sure. You've mentioned that over time, it's kind of been expected. And as we've talked about it in the show with TerraForm Power, this relationship with Brookfield is kind of a big part of the thesis for the company, or why we were so attracted to it. But,
Yep.
It has been for a long time, as you said, a suspicion that sooner or later these companies were going to come together. Why do you think now was the time that those companies chose to combine?
So I think probably the biggest one is something that Brookfield recently announced that it was going to do with Brookfield Renewable Partners, and just the timing made sense in terms of the corporate structure change. We'll talk a little bit about too, to go ahead and combine the whole entity into a single corporation, especially for current investors in TerraForm Power. So the short version, TerraForm Power is a corporation. Brookfield Renewable Partners is a publicly traded partnership. There's some differences with the tax implications. There can be challenges between holding the partnerships in tax advantage accounts like 401ks and Roth IRAs and traditional IRAs. So I think it was just a more shareholder friendly time to do it versus doing it when if Brookfield Renewable was going to remain a partnership. It wouldn't have been necessarily the most shareholder friendly way to acquire TerraForm Power with a stock transaction.
Sure. I think one other thing that I noticed when you look at this transaction that I suspect maybe played a role as well. If you look over the past several years, these stocks have kind of traded together, or the stocks have kind of moved up and down together. You saw over the last 3 months or so those kind of diverged, and the Brookfield Renewable Partners stocks can kind of continued up on their upward trend, while TerraForm kind of flattened off. When you're doing an all-stock transaction, when you can kind of exchange your higher price stock for a lower price stock that you think is undervalued, there's some attractiveness there as well.
Little arbitrage.
Exactly, and that's Bruce Flatt and the folks at Brookfield are great at finding those opportunities to buy assets that are undervalued, or maybe when the market doesn't recognize the true worth that they have. But you mentioned this changeover in the structure of Brookfield Renewable, and that's raised some questions among investors. We did get a question from our listener Rod in Albuquerque, who says, "I currently own TerraForm Power in a Roth IRA. With the upcoming merger with Brookfield Renewable, will he now have an MLP in his Roth, or will it only be the new corporation?" As you mentioned, there's moves to transition Brookfield Renewable into a corporation. So for investors that own both of these companies in a tax advantaged account, how should they be thinking about this merger and how it will affect those holdings in tax advantaged accounts?
So I'm going to a couple things. So first of all, just to explain for everybody that's listening, this is just really good information to have as you're investing. In general, if you have a Roth IRA, a traditional IRA, or a 401k that you can buy stocks in, one of the biggest benefits is being able to take advantage of deferring, or in the case of a Roth, avoiding any taxes whatsoever on your investments, right? The catch with MLPs, master limited partnerships, or publicly traded partnerships, is that many of them generate a type of income that's called unrelated business taxable income, or UBTI. The thing with UBTI is if you earn through the dividends that you're paid, if you earn more than $1,000 in UBTI in any 1 year, and that's not just in each IRA. So let's say you've got a Roth IRA, and then you've got a rollover IRA from a prior employer, and then you've got another 401k that you own some stocks in, that you're able to own stocks in. Across all of those accounts, if you generate more than $1,000 in UBTI, you actually have to pay tax. So it's as you know, for younger investors, it's not necessarily that big of a concern. But as you get older, as your wealth increases, the potential of creating a tax event inside of a tax advantaged account is why, in general, it's recommended that you avoid owning these kind of partnerships inside of your retirement accounts. Now, with that said, of the general outlay of owning partnerships, the Brookfield partnership, so Brookfield Renewable, Brookfield Infrastructure Partners, they don't generate UBTI through their investments. They're structured in a way so that's really not a concern. But some brokerages still won't let you buy any company that's a partnership inside of your retirement accounts. So even though they say it's okay, sometimes some brokerages won't even let you buy it. So that's a limitation, right? So that's Rod's concern, is if he gets these BEP shares, what's it going to do for him? And since it's Brookfield, it really wouldn't create any tax event for you. But again, the bigger idea is Brookfield wants to go ahead and make that a non-issue. But the other part of it too, and I think honestly this might be a bigger one, as its partnerships have gotten larger, more valuable, and as the opportunity to grow in these renewable spaces and as global infrastructure spending grows, these entities are going to get much bigger over the next decade, and they're really limited in terms of showing up in major stock indices being structured as partnerships. So I think there's the potential, especially as as indexes and index funds have become a bigger way most people invest, it's going to create a larger potential pool of investors, and that means more capital for these growth focused entities. Does that make sense? Did I explain that well?
Yeah, so Brookfield is making these moves to convert their existing partnerships into corporations. We're seeing that occur with Brookfield Renewable Partners. They're creating a Brookfield Renewable Corporation. They're doing the same with Brookfield Infrastructure Corporation, where you'll be able to own in a corporate form the economic equivalent of owning Brookfield Infrastructure Partners. As these, Brookfield's obviously making a big priority of giving investors the opportunity to own these previously partnerships in a corporation form that the investor would like. As unrelated to the TerraForm Power merger, as Brookfield opens up these continued opportunities to own Brookfield Infrastructure, Brookfield Renewable in a corporate form, if you're an investor that only owns the partnerships today, as the opportunity to own the corporation rises, what are the pros and cons of an investor switching over to owning that corporate form versus just continuing to hold the partnership that they already own today?
So the key thing here is that when you think about a corporation versus a partnership, you get different tax documents. You get your Schedule K1 for your partnerships, and most of your taxes are the distribution that you earn is probably going to be taxed at your marginal income tax rate versus a qualified dividend, which is what most corporations are able to pay. That is taxed at the 15% for most earners, taxed at the 15% long-term gains tax rate. So again, we haven't seen what the yield's going to be because the corporate entity will pay corporate income taxes. The partnership is what they call a pass-through. It's designed to pass more cash through without paying taxes internally. So there's a lot of kind of moving needle, or kind of the needle needs to move on some certain things to really understand what you're buying to say for sure. But in general, a corporation, you pay lower taxes on your dividends, and you get a 1099, so it's a little bit cleaner when it comes time to actually do or file your taxes at the end of the year. What am I going to do? I'm probably not going to do anything again until I see what the numbers look like, and it could be an opportunity, kind of like what Nick mentioned earlier with how TerraForm stock has kind of diverged over the past 3 months or so from Brookfield renewable stock. Honestly, I might just play arbitrage and buy one or the other as I'm adding over time based on if it looks like one is a better valuation for some strange reason, which sometimes you see that with dual share stocks. Sometimes every once in a while the market gets kind of screwy and one's just cheaper for some reason.
Sure, yeah, you already can see that in some instances. I don't know how big the difference is, but there already exists Brookfield Property REIT in addition to Brookfield Property Partners. So we're seeing a similar framework play out with the changes that the company is making to Brookfield Infrastructure Partners and Brookfield Renewable Partners. We'll have to see as the details come down from the company. I'm sure we'll talk about that on this show. Going back to the TerraForm Power merger with Brookfield Renewable, when you look at the assets that this brings together, bring together the TerraForm assets with Brookfield Renewable, what does this kind of create for the business going forward? And do you feel this business is stronger together than they were separately?
Yeah, there's definitely some benefits to combining it. It should be, just right off the top, it's going to be more. I think it's going to be more cost efficient, just because corporate structure costs should go down. I think you're going to see the retention of the best management from both. The management that was running TerraForm Power are all people with the Brookfield background anyway. So I don't know that it necessarily strengthens management. There should be, I hate this term, but you should see cost efficiencies. You really should, because Brookfield already knows everything about TerraForm, how it's run, knows where it can find cost opportunities. But I think the biggest thing is that Brookfield Renewable pre-merger is still, almost 3/4 of its cash flows come from hydroelectric. That's just kind of where its legacy business is. After this merger, I think more than 40% of its cash flows are gonna come from wind and solar. So it's really moving the entire business towards where the market is and where the real opportunity is, and that's corresponding to the costs of wind and solar production. And now with energy storage costs falling so much that are really on parity with just about any other source of electricity on a global basis. So I think the timing is right to simplify how Brookfield invests. If you look back at TerraForm Power's biggest needle-moving transaction since the acquisition, it acquired, I think Saeta is how you pronounce it. It was a Spanish wind and solar producer, and that was funded by equity investments that Brookfield made into TerraForm Power. So now, instead of Brookfield giving money to TerraForm Power and then TerraForm Power going and spending that money on the asset, it's just one business, and then one business makes a business decision on what assets to buy, what assets to sell, what assets to improve, however it works. So I think it really does make a lot of sense in the long term to leverage the best growth as a business unit.
Sure, yeah. When we've talked about in the past Brookfield Renewable, the fact that they were so overweight to hydroelectric versus having that exposure to wind and solar, it really is exciting to get that exposure now in Brookfield Renewable. Last question, kind of on this merger. We saw the shares pop up 11% when the merger news was announced. If I'm not mistaken, the premium that Brookfield Renewable is offering, coincidentally, is 11% above where the shares were trading at that time.
Right.
We see this transaction is very likely to close given the relationship between Brookfield Renewable and TerraForm Power. As someone who owns TerraForm Power, how are you going to handle your shares in this period between now and the closing of this transaction?
I'm not. It's business as usual for me. I own significant shares of both, for looking at them for high yield and for the long term dividend growth, and that's not changing. I've also kind of kept them in the same bucket in terms of exposure risk, because so much about TerraForm Power is tied to Brookfield, and it's a related party already. So in a way, I've kind of already considered them one unit in terms of that risk. So I'm not making any changes. I'm not selling TerraForm because of this. I'm not going to make any changes to my portfolio. I'm just kind of expanding, some of the other entities that I'm looking for, in terms of where I'm going to invest new money. That's probably the only thing that I'm doing different.
Okay, Jason, we talked about on the first half of the show how this year has really kind of been brutal for some of our favorite yieldcos, TerraForm Power merging with Brookfield Renewable, Pattern Energy getting taken private by a Canadian pension fund. Since those companies are no longer on the market, it's time to start looking for new renewable yieldcos to add to our watch list. Jason, do you have a couple companies you want to share with us?
Yeah, I do. I've got a couple that are on my list. If you want, we can start talking about Atlantica Yield. The ticker is AY. How's that sound?
Yeah, well, before we get into Atlantica Yield, Jason, when you're just looking at just across the sector at yieldcos, what are you looking for in these companies? What are the boxes you like to check off that says this is a company that's attractive to me?
So there's probably three things that I kind of focus on. Number one is trying to find a good margin of safety. And what I mean by margin of safety, because in typical terms, you think of margin of safety, you think, hey, it's a company that's got a ton of cash sitting on their balance sheet, a company that doesn't have very much debt. But the reality is that you look at any of these yieldcos, and generally they don't carry very much cash on their balance sheet, and they all have a lot of debt. So how can they have margin of safety? And the way they have margin of safety is they have strong contracted cash flows. Just like any other utility, they invest in these wind and solar farms, natural gas plants in a few cases, Atlantica Yield's case in water systems, and then they have these long-term contracts to sell the output, or they're regulated. They have some units that are regulated utilities. So these kind of businesses, they generate steady cash flows no matter the economic environment, right? So you want to find the ones that have the contracts in place for large cash flows that support their dividend, and don't put them at risk of big the big interest expenses that they're not going to be able to meet, that are going to force them to then cut their dividend and leave investors high and dry. So that's the first thing I look for. Next thing I look for is that typically with these yieldcos, they have a sponsor. They have another company in the background. It's either publicly traded, like Brookfield Asset Management is for the Brookfield family of entities, or in Atlantica Yield's case, it's privately held, Global Infrastructure Partners. You want to have a strong financial backer, typically that has some experience in that specific arena of assets, and a history of being a good, responsible investor and a long-term focused investor. So those are the two things that I look for. Number three, I usually try to find, this is a second part of the margin of safety, but specific to the yield. I like to find one that is generating, 20% more cash flows, distributable cash flows, than they actually need to support their dividend. That's usually a pretty good margin of safety for this kind of business.
Okay, Jason, so taking that framework, let's now move on and talk about Atlantica Yield. When you take a look at their assets, you mentioned the water assets that they have. What really stands out to you about the business?
So, you hit on a couple things. It does have a strong yield. 18 years weighted average contract life is quite good. Again, that's the source of those predictable cash flows. So those are things that I definitely like. I also like the fact that it's actually relatively small with 25 assets and about 1.5 gigawatts of energy generation capacity. It's certainly on the smaller side. So that you just kind of draw that out on paper, and it says, well, hey, this should be one that has an opportunity for outsized growth because it can participate in smaller deals that can give it meaningful gains and results, right? So those are things that I definitely like a lot about it. Geographically, it's got some interesting diversity. It's got some assets in Europe. It's got assets in North America. It's got assets in South America. So those are things that I definitely like about it. Now, let's talk about why I haven't bought it yet. Why it's just been on my watch list for a few months. And I think the short version is, if you look at its corporate history, I'm not completely confident in its corporate backing at this point. It was founded by Abengoa, which is, I'm probably not pronouncing that correctly. It's a Spanish company. And a couple of years ago, it sold off most of its stake to Algonquin Power and Utilities, which is a Canadian utility company that actually has a lot of operations in North America, in the U.S. And I think Algonquin owns a little over about 45% of the company now. So here's where I'm concerned. Number one, it's had a fairly recent transition in its sponsorship, which in and of itself isn't necessarily a bad thing. But the difference here, so you think, well, you've got a Canadian, utility company that's getting involved. That's kind of sounds like Brookfield, right? The difference is that Algonquin doesn't really have the same history of developing assets outside of the regulated utility space, and I think I want to kind of give the story time to play out a little bit more. Algonquin and Abengoa have a joint venture that they've created to develop primarily just renewable assets. And Atlantica has a first right of refusal, which is the typical way these deals are structured when there's a sponsorship for a sponsor and a yieldco. In other words, it has the right to kind of pick and choose from this list of developed assets and buy the ones that it's the most interested in. So that's kind of good. But it's typical, but and it looks good. But I want to give it time to play out and see how it does it generate meaningfully positive results. Is Algonquin really committed to this venture, or is it going to get to a point where it's not able to really focus on its regulated utilities business, and it's not able to really dedicate the resources to this joint venture and to Atlantica? So I'm just, that's my concern. That's why I'm not ready to pull the trigger just yet.
Yeah, it still sounds like evaluating management, making sure that the assets that they now control are going to be managed in a way that is going to consistently produce returns for shareholders over time. Moving on to Clearway Energy, that's the second stock that you've added to your watch list. What really stands out to you about Clearway Energy?
So Clearway Energy, ticker CWEN. I think it owns like seven gigawatts.
Yes.
Of power generation, mostly wind and solar and some natural gas. So again, it's substantially bigger than Atlantica Yield. It's also a more familiar name in North America. It was formerly called NRG Yield. It was sponsored by NRG Energy, the utility. Global Infrastructure Partners, which is a privately held private equity infrastructure investment partnership, acquired it about a year and a half ago, and renamed it Clearway Energy. So the things that concern me about it, really it's not the things, it's the thing. It has pretty outsized exposure to Pacific Gas and Electric, PG&E, which most listeners should be familiar with. That's the large regulated California utility that's going through bankruptcy. It's related to all the fires out here in California that it has some liability for. And the thing is that the substantial amount of its cash flows are tied to selling power to PG&E.
Yeah,
so one of the things,
I saw the number 30%, Jason. 30%. So just a really significant customer for them.
Yeah. So so there's the risk. The risk there is depending on what happens with its bankruptcy. There's the first risk is there's a risk of those cash flows getting slashed if the bankruptcy courts require renegotiation of those rates. I'm not particularly concerned about that, to be honest with you, because they're not exactly, these aren't sweetheart deals. They seem to be pretty fair market rate deals. So that's in Clearway's favor. But you look at you go back to when did they cut the dividend? About a year or so ago, I guess. They slashed the dividend in half when the rumblings were coming to PG&E's bankruptcy. So I guess the best way to put it is that right now management's really focusing on deleveraging the balance sheet, cutting costs, putting it in a little bit better financial position to have a little bit bigger margin of safety, with the idea that going forward, if it has large customers, number one, that it's trying to reduce its exposure to single customers. Number two, creating a situation where it won't have to slash its dividend in half if there is a major issue with one of its large customers going forward. I think for me, I'm at a point now where I'm relatively confident with where the business is. The yield is sustainable where it is. Cash flows are going to grow. I don't know. I think they'll grow probably 15 to 20% this year. I think their target is 18%. So it should produce a pretty substantial amount of cash available for distribution. And then once the PG&E bankruptcy kind of plays out a little bit more, there's a substantial amount of cash that it has that's sitting at one of its subsidiaries that it can't even touch. And then the rain should come off of that, and then it should be able to redeploy that cash flow, whether it uses it for a special dividend or to pay down debt or to acquire new assets remains to be seen. But the point is, I think the company is pretty strong right now. There's some line of sight to what's going on, and I've got faith in Global Infrastructure Partners. They're a big name. They're well established, and they're really good at what they do. So I think I'm ready. Honestly, I think this is going to move from my watch list and it's going to get added to my portfolio probably in the next month.
Yeah, Jason, just to kind of add to the things that you said, they had to cut the dividend last year, but before the PG&E issues really materialized, they had been on track to increase their dividend 5 to 8%, which is pretty healthy amount. PG&E is still paying those bills on those power purchase agreements as they come due. It's just because of the nature of the way bankruptcy proceedings are, those assets are kind of put into escrow until all the proceedings can kind of be decided. So it's really difficult for Clearway right now because they have this money that otherwise would be coming in they could redeploy that's just kind of sitting in cash. But it seems likely that PG&E will emerge from bankruptcy and with these agreements more or less intact. That's still a question mark. But as that cash becomes free again, it really opens up a lot of opportunities for the company. Maybe they can raise that dividend back up to where it had been previously. But at the very least, the way the cash flows are playing out, you should get pretty reliable increases in dividend payouts over time. And if you look at the way their debt is trading, you mentioned that 30% of PG&E's cash flow, Clearway Energy's cash flow is related to PG&E. But if you look at the way their debt's trading, all their debt, at least that I looked at, is trading above par. So there's not a lot of concern in the credit markets that the company is not going to be able to, because they've lost access to this cash flow, that they're going to have issues. Really strong balance sheet. There's some concerns hanging over the stock. But I think from my view, I agree with you, Jason. This seems to be an opportunity if you're looking for a yieldco, reliable payout over time.
Yeah, I think probably the best evidence to use to demonstrate kind of what what the credit market thinks, what bankers think about Clearway is Clearway was able to refinance around $600 million in debt in December at a lower interest rate. Banks don't do that if they're concerned about your ability to generate cash flows and repay your debt.
Right, yeah. So it's not to say that these bankruptcy risks aren't real, aren't something to be concerned of as a shareholder and continue to monitor. But I wouldn't be as scared as you might be otherwise when you hear bankruptcy, when you hear 30% of cash flows.
Right, exactly. California is going to continue to need electricity. PG&E, whatever it looks like on the other side of bankruptcy, is going to need to continue, purchasing power that it can't produce itself. And its problems are how it's managed, its existing assets and its infrastructure of power lines and gas and gas lines. Not that it was overpaying for the power that it was buying from yieldcos like Clearway.
Sure. Yeah, so hopefully they keep the lights on there for you there in California, Jason. I know they've had those rolling blackouts.
I have solar panels now, and I'm planning on getting a storage system sometime in the next year, so I won't have to worry about what my local utility, which is Southern California Edison. And I'm not exactly a big fan of them either, but I plan on removing that thing from my problems.
Yeah, I don't blame you, Jason. We're gonna move on from the stock talk here. A couple, I like to talk with you about college football a little bit, and we just had the national championship on Monday. As you look back over, this past season, what were your kind of biggest takeaways? What will you remember?
I will remember that Alabama lost much sooner in the season than anybody expected. Losing a home game. It's been a while since that's happened for Alabama. But at least you lost at home to the eventual national championships. My Georgia Bulldogs lost at home to an eventual 4-8 South Carolina team. So, yeah. But we did win the Sugar Bowl. So.
Very exciting.
Yeah.
We can't be in the SEC championship game every year, Jason. But one of these days we'll get back there. I do want one thing I want to ask about is obviously this year in college football, the biggest thing has just been so many incredible quarterbacks. Joe Burrow won the Heisman. Yeah. Tua's coming out this year. Trevor Lawrence had another great year. As you look to the NFL, Tom Brady's towards the end of his career. Drew Brees coming, starting to hit the twilight of his career. As you see these new quarterbacks rising up, kind of how excited are you to watch these folks as they, move on to the pros?
One of the things I'm really excited about is that you look at Joe Burrow, and he's somebody that in a lot of ways he's like the prototypical quarterback that we've seen in the NFL for 40 years, right? He's 6'6". He's got a cannon for an arm. He stands high in the pocket. He makes all the throws. But oh, by the way, he can also outrun most of the other team's linebackers and extend the play like crazy. I think it's so exciting right now, right? That that you're seeing this shift away from the pocket passer to the quote unquote dual threat, which was always really just code for the guy that runs. And you have these guys that are truly phenomenal athletes at every aspect. Tua is another great example of that. This is a guy who's got an absolute cannon. He can make every throw. He's got precision, but he's also super fast. But these are guys like, that I think you're starting to see more and more, because guys like Breeze and Rodgers, those are guys that kind of, start really 10 years ago started showing how valuable that was, right? That ability to create separation, extend the plays, and then make the big throw. Or, oh, by the way, they could also take off and run a little bit if they need to. But this is the next evolution, right? Taking it to the next step. So I'm really, really excited. I might start watching the NFL again.
Yeah, hey, that's it's another year till college football. We'll get a little bit of a football fix here with the playoffs. But excited to have you on, Jason, as always. And next college football season, I'm sure we'll chat some more.
Yeah, we will. I'll say this: I'm pretty excited. We've got pitchers and catchers that are reporting in less than 30 days, so I can. I've got something to go to here in mid-February.
The Astros cheating scandal is exploding on Twitter right now.
Can you remember the last time baseball got this much news in January?
It is absolute. There's all these reports of Altuve and Bregman using buzzers in their jerseys, and there's a burner account that's claiming to be Beltran's niece. All kinds of stuff. It's crazy.
Ooh, buddy.
Well, folks, we're gonna have to let you go so me and Austin can hop on Twitter and follow this breaking news. Thank you for listening as always, and remember, as always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for his work behind the glass. For Jason Hall, I'm Nick Sciple. Thanks for listening, and Fool on.